September 2008, a money market fund called the Reserve Primary Fund announces it can no longer maintain its $1 share price. Within 48 hours, investors pull $300 billion from money market funds across the United States. The safest investment in the American financial system becomes the epicenter of a systemic run. This wasn't supposed to happen. Money market funds were designed as the last refuge, the place you go when everything else looks dangerous. But that's exactly why they failed first. When financial systems break, the assets that fail fastest aren't the ones labeled risky. They're the ones everyone agreed were safe. This pattern repeats across every major collapse in modern history. And the mechanism behind it is structural, not psychological. The question isn't whether safe assets will fail during the next systemic break. The question is why the safest assets consistently become the most dangerous when the system they depend on starts to fracture. This is financial forensics. We study past system failures to understand what survives. Today, we're examining why safety itself becomes a systemic vulnerability. Start with a simple framework. Every asset carries two forms of risk that operate on different timescales. The first is price volatility, the risk that an asset's value fluctuates day to day. This is what most people think of as risk. Stocks go up and down. That feels dangerous. The second is systemic dependency, the risk that an asset relies on institutional continuity to retain any value at all. This risk stays hidden until the system itself breaks. Safe assets minimize the first risk at the cost of maximizing the second. They trade visible volatility for invisible systemic exposure. A government bond doesn't fluctuate much because it's backed by the state's ability to tax and issue currency. But if that state can't honor its obligations, or if its currency collapses, the bond doesn't just lose value, it loses the entire foundation of its claim. Gold has no yield and high price volatility, but it carries no systemic dependency. It doesn't require any institution to continue functioning. The safest investments in any given system are the ones most perfectly calibrated to that system's continuation, which makes them the most fragile when that system breaks. Weimar Germany, 1923, German government bonds were considered the safest asset in the country. They were backed by one of Europe's most advanced industrial economies. They paid predictable interest. They were held by pension funds, insurance companies, and every institution responsible for preserving wealth. When hyperinflation began, bondholders didn't panic immediately. Bonds still paid interest. The coupons arrived on schedule, but the currency those coupons were denominated in was collapsing. Bond investors received every promised payment and still lost everything. The bonds didn't fail because they were poorly designed. They failed because they were perfectly designed for a system that no longer existed. This is the core mechanism. Safe assets derive their safety from system stability. When that stability disappears, the safety disappears with it. Argentina, 2001. The peso had been pegged to the dollar for a decade. Argentine government bonds paid dollar-denominated interest rates while being treated as domestic safe assets. Banks held these bonds as reserves. Pension funds built portfolios around them. They were the foundation of the country's financial system. When the currency peg broke, the bonds didn't just decline in value. The entire legal framework that defined them as safe assets ceased to function. The government froze bank accounts. It forcibly converted dollar deposits into devalued pesos. The safest assets in the system became inaccessible precisely because everyone had agreed they were safe. The pattern isn't limited to currency collapses. It appears in every form of systemic break. During the 2008 crisis, AAA-rated mortgage securities failed before junk bonds did. The securities designed to be safest were the ones most exposed to the assumption that American housing prices would never decline nationally. That assumption wasn't irrational, it was historically supported. But it was also systemic. Once it broke, the assets built on it had no fallback position. Junk bonds, by contrast, were priced for company-specific failure. Their risk was already visible and distributed. When the system fractured, they had less distance to fall. Here's what makes this pattern so consistent. Safe assets attract the most systemic concentration. When something is labeled safe, institutions are required to hold it. Regulations mandate it. Pension funds default to it. Insurance companies build reserve requirements around it. This creates a crowding effect. The safest assets become the most widely held, which means they become the most systematically important. And when systemic importance meets systemic failure, you don't get a market correction, you get a liquidity crisis. The Reserve Primary Fund held Lehman Brothers commercial paper because Lehman was considered systemically safe. When Lehman collapsed, the fund couldn't liquidate fast enough. The problem wasn't that investors panicked. The problem was that everyone needed to exit simultaneously through a door that only existed because everyone had agreed not to use it at the same time. This is the architecture of safe asset failure. Safety creates concentration. Concentration creates systemic dependency. And systemic dependency evaporates the moment the system shows signs of breaking. Now apply this framework to the present. Global sovereign debt now exceeds $90 trillion. Government bonds remain the definitional safe asset in every major economy. Central banks hold them as reserves. Commercial banks use them as collateral. Pension systems treat them as the foundation of long-term stability. But these bonds only function as safe assets if the governments issuing them can service the debt without destroying the currency or triggering a fiscal crisis. Japan's government debt exceeds 250% of GDP. The Bank of Japan owns nearly half of all Japanese government bonds. The bonds are safe because the central bank guarantees them by creating currency. This works until it creates a different problem. Either the debt remains serviceable and the currency weakens structurally, or interest rates rise and the debt becomes unserviceable. There's no third option that preserves both currency stability and debt safety indefinitely. The European sovereign debt crisis demonstrated this at a smaller scale. Greek bonds were treated as safe assets across the Eurozone until the moment Greece couldn't roll over its debt. Then the safety vanished instantly, not gradually. The bonds went from being used as bank collateral to being worth 30 cents on the dollar within months. The holders weren't speculators. They were pension funds and banks required by regulation to hold safe European sovereign debt. This is what systemic dependency looks like when it crystallizes. The asset doesn't decline in value through normal price discovery. It loses its entire classification as a safe asset, and the market reprices it from first principles. U.S. Treasury bonds face a different but related dynamic. They remain the global reserve asset. Central banks worldwide hold them as the safest store of value. But U.S. federal debt is rising faster than GDP growth, and the interest payments on that debt are beginning to rival the defense budget. At some point, the math doesn't resolve through austerity or growth. It resolves through inflation, restructuring, or a shift in the reserve currency framework itself. None of those outcomes are predictable, but all of them would destroy the systemic foundation that makes treasuries safe. The mechanism is always the same. The safest asset is the one most dependent on the system's continuation, which makes it the least safe when the system's continuation becomes uncertain. Cash deposits present the same problem in a different form. In a functioning banking system, cash in a savings account is perfectly safe. It's insured, it's liquid, it doesn't fluctuate. But that safety is entirely dependent on the bank's solvency and the insurance fund's credibility. Cyprus, 2013, the government imposed a one-time levy on bank deposits above 100,000 euros. Deposits were considered safe until the government needed revenue and the banking system needed recapitalization. The safest asset became a tax base. This wasn't a market failure. It was a policy decision made possible by the fact that everyone had concentrated their wealth in the same systemically dependent asset. Lebanon, 2019, banks froze withdrawals and imposed capital controls. Depositors couldn't access their own money. The legal framework that defined deposits as safe and liquid ceased to function. Again, the people who lost the most were the ones who had done everything right, according to conventional safety rules. The pattern extends beyond government bonds and bank deposits. It includes any asset whose value depends on institutional continuity. Corporate investment-grade bonds are considered safer than equities, but during a systemic crisis, they fail faster. Equities represent ownership. If a company survives, the equity retains residual value. Bonds represent a contractual claim that disappears entirely if the company defaults or if the currency collapses. During Weimar hyperinflation, German industrial stocks preserved some purchasing power because they represented claims on physical productive capacity. Bonds denominated in marks became worthless. The safer asset failed first because its safety was contractual, not tangible. Real estate presents a more complex case. Property is often treated as a safe long-term store of value, and in many contexts, it functions that way. But real estate carries hidden systemic dependencies. Property rights require legal enforcement. Property taxes require a functioning state. Liquidity requires a functioning credit market. When those systems break, real estate doesn't just lose value, it becomes impossible to transact. Venezuela after 2015, property prices in Caracas remained theoretically high in Bolivar terms, but nobody could sell. The credit system had collapsed. The legal system couldn't enforce contracts. Property became illiquid despite being physically intact. The asset was safe, in theory, but its safety depended on institutional mechanisms that no longer functioned. This is the distinction that matters. Physical assets without systemic dependency retain function even when systems break. Assets that derive value from institutional promises lose both value and function simultaneously. Gold functioned as money in Weimar Germany because it required no institutional backing. Cigarettes functioned as currency in post-war Europe for the same reason. These weren't the safest assets during normal times. They were the assets that remained functional when normal times ended. The framework clarifies why diversification within a system doesn't protect against systemic failure. If you hold government bonds, bank deposits, and investment-grade corporate debt, you're diversified across asset classes, but all three depend on the same underlying system functioning. When that system breaks, the diversification provides no protection. You're holding three different claims on the same fragile foundation. This is what happened in 2008. Investors who diversified between stocks, bonds, and real estate still faced simultaneous collapse because all three markets were exposed to the same credit system failure. The safest portfolios by conventional standards were the most exposed to systemic risk. Now consider what this means for current conditions. Interest rates across developed economies spent over a decade near zero. Central bank balance sheets expanded by trillions. Government debt levels are higher than at any point outside of world wars. These conditions exist because the system required them to avoid immediate collapse. But they also create structural fragility. When interest rates are zero, there's no buffer for cutting them further. When central banks already own massive portions of government debt, there's limited capacity for additional intervention. When government debt levels are historically extreme, there's less fiscal space for crisis response. The system is calibrated for continuation, but the calibration itself has eliminated the shock absorbers. Safe assets are priced for this continuation. They assume central banks can manage crises indefinitely. They assume governments can service debt without currency destruction. They assume the legal and financial infrastructure will remain intact. These aren't unreasonable assumptions. They're assumptions that have held for decades in most developed economies. But they're still systemic assumptions, and assets built on systemic assumptions fail systemically when those assumptions break. The practical implication isn't that safe assets will definitely fail, it's that their safety is conditional. A government bond is safe if the government remains solvent and the currency remains stable. A bank deposit is safe if the banking system remains functional and the insurance fund remains credible. These conditions have held consistently enough that the conditionality becomes invisible. Safety starts to feel inherent rather than derived. But history shows the conditionality resurfaces exactly when it matters most. The assets that survive systemic breaks are the ones that don't depend on the system continuing. They carry different risks, price volatility, storage costs, lack of yield, but they don't carry systemic dependency. This creates a fundamental trade-off that most investors never explicitly consider. You can optimize for stability within the current system, or you can optimize for survival across system changes. Safe assets do the first. They're designed to be stable as long as the institutional framework remains intact. But that design makes them maximally fragile to the one risk they can't price: the risk that the framework itself breaks. This isn't a prediction, it's a description of structural exposure. The question isn't whether the current system will break. The question is whether your understanding of safety accounts for the possibility. Most conventional financial advice doesn't. It treats government bonds as risk-free. It treats bank deposits as perfectly safe. It assumes the institutional framework is a constant rather than a variable. That assumption works until it doesn't, and when it doesn't, the assets optimized for system stability become the most dangerous positions to hold. The mechanism is mathematical. Safe assets are safe because they're widely held. They're widely held because they're safe. This creates a reflexive loop that functions perfectly in stability and catastrophically in crisis. When everyone needs to exit simultaneously, the safest asset becomes the least liquid. When everyone assumed the same institutional continuity, the break in that continuity destroys value across the entire asset class at once. This is why studying financial history matters. Not to predict the next crisis, but to understand the mechanics of how safety inverts during systemic stress. Every major collapse in the past century followed the same pattern. The assets that were supposed to be safest failed first and failed most completely. Weimar bonds, Argentine dollar deposits, Greek sovereign debt, reserve primary fund shares, different contexts, different trigger events, same structural mechanism. Safety is always systemic, and systemic safety always fails systemically. Return to September 2008, the reserve primary fund breaking the buck. At the time, it looked like an isolated failure. One fund that made a bad bet on Lehman Brothers commercial paper, but the real story was structural. Money market funds were designed to be safer than banks. They were supposed to be the place you go when you're worried about everything else. That design created concentration. Trillions of dollars flowed into assets that were only safe because everyone agreed they were safe. When one fund broke, the entire category faced a run. Not because investors were irrational, because the safety was never intrinsic, it was institutional. And institutions are variables, not constants.